So what is this payoff first of all? So payoff means what are they going to get, uh, not net of premium. That means without considering premium, who is going to get what? So say for example the holder. So how much is the holder getting? Let's say at the time of expiry, without taking into consideration of uh, premium. That is called payoff. Okay. Say for example X and Y. This is the holder and this is the writer. Now 100 is the strike price. Okay, and on the expiry date the spot price is 120. Okay, so in this case the value is 20. The value is 20. We are not going to see the premium what the holder has paid. I will say the value is 20. Net profit is 15, but the value is 20, or the payoff is 20. Okay, now coming to this statement. Okay. One second. At expiration, the payoff of your call option to the owner is either zero. Zero means when it is, when zero means what? Zero will be
So the owner in this case is the buyer, right?
buyer.
Like the holder.
Yeah, buyer, right. So in case if the spot price is 80, then he is not going to execute. So that time its value will become zero. Okay, premium will become zero in the market. Okay, so zero, or what will happen if it is 120, then it will be 20. I said, what do you mean by 20? 20 is this. S represents spot. Okay, S represents spot, X represents strike price. Strike price is only, so this is strike and this is spot. So 20. So either it will be zero or it will be these two difference, where S is the price of the underlying asset. That means spot at expiration, and X is the exercise price of the call option. The max function tells us that if spot is lower than strike, that means this part. If spot is lower than strike, at expiration, the option value is zero. That is, it expires worthless and will not be exercised. It will not be exercised. Why? We will exercise when it is beyond 100. Is it okay?
Yes, sir.
Aha.
And the next para.
This is put option. Yeah, I have not
Yeah.
explained
Okay.
put option yet. So
Okay.
once I explain, it will be fine for you. What is the other doubt?
So in chapter 60, reading 66, they've talked about credit default swaps. Have we done that?
No, I have not spoken
Okay.
yet.
Okay.
So that you can, right now you can skip, because I just spoke about forward, future, and call options, not even put options.
Okay.
But then the way they have given it is not so very good, because it is kind of mixing up different things. Uh, so yeah. So wherever you don't see forward, future, and call options, rest all you don't read now, or if you read also, you just ignore it now. And then When I will finish up the training, then you may read further. Then
Okay, sir.
okay.
So we also spoke about hedging yesterday, and
Uh,
there's partially hedged mentioned in reading 66.
Reading 66 A or B.
Yes, A.
Acha,
Yeah, sir. Go ahead.
partially hedged. Hmm. Okay. If the risk of the forward contract exactly matches an existing risk, then the forward contract can be used to fully hedge the existing risk. If a derivative is used to reduce but not entirely offset an existing risk, we say the existing risk is partially uh, hedged. That means it is partially reduced. Say for example, uh, that farmer only. Now, now this is hotel. Now he said this hotel said he wants only 100 kg onion. Okay, so he said I will pay you only for 100 kg. I'm entering into the contract only for 100 kg. But this guy is producing 150 kg. Now what to do? So from farmer's perspective, it is only half hedged or partially hedged, na?
Yeah.
So that time what he may do, if he still wants to fully hedge, he will he will get in touch with another hotelier, and there he will enter into the contract only for 50 kg if he wants to fully hedge.
Okay.
So that is partial hedge.
Okay. Got it.
Hmm. Yeah. Any other doubts?
Yes, so in underlying assets and variables,
Hmm. Yeah.
fourth point. Yeah, that one.
An interest rate, for example, the 1 year treasury bill rate, similar to derivatives based on bonds, uh, except that a higher interest rate means gains for the buyer of an interest rate forward, whereas higher interest rates mean lower bond prices and losses for the buyer of the bond forward. Okay. The underlying for your derivative is most often a stock or bond price, the level of a stock or bond index or an interest rates. Here we give examples of different underlying assets and variables for derivative contracts and nature of the risk they transfer or modify. We present more details about derivatives based on this underlying assets in subsequent readings. Okay. See, an interest rate, for example, 1 year treasury bill rate, similar to derivatives, is based on bonds, except that a higher interest rate means gains for the buyer of an interest rate forward. So when the interest rate, okay, interest rate forward means what? Uh, interest rate forward, that means, uh, let's say you are agreeing to borrow money, okay, at so and so interest rates in future. That means forward only at the future date. You agree to borrow at 7%. Now, this is, let's say, after 4 months. So after 4 months, what should you do? You should borrow at 7%, right? But in the market, it became 8%. So for Mr. X, this is a gain. Why it's a gain? Because you are borrowing at 7%, whereas in the market 8% is going on. So it will be, it's a gain. So when the interest rate is going up, you are getting the benefit. Is it okay? That means it's a
Yes.
forward contract where the underlying asset is interest rate. It is a forward
Okay.
contract where the underlying asset is interest rate. That's why it is interest rate forward.
Okay, so
Now,
if the market price is higher than the strike price,
huh,
then the buyer is at a gain.
but it is not, uh, uh, you know, you should not use the word strike because it is forward, the terminology.
My bad.
Okay, so that strike price, we use it in options. Okay, but for understanding sake, okay, yeah. So it is the agreed upon price. Agreed rate is 7%. Whereas in the market it is 8%. So 1% is the gain. Okay, so now that means here it is favoring you, favoring Mr. X. Now suppose Mr. X is holding a bond. Uh, Imagine, or you have decided to buy, there is X and Y. Now X says I will buy in 4 months, I will buy bond from you at 1,000 rupees. In 4 months, X has entered into a contract with Y that in 4 months, that means after 4 months, I will pay 1,000 rupees and you have to give me bond. Now, when the interest rate is going, went up, here in the first case, Mr. X got profit. But in the second case, what will happen? When the interest rate went up, now Mr. X will be at loss. Why? Because when the interest rate goes up, bond price will come down. Okay, now don't get into like why it is coming down, because that we will discuss in fixed income subject. It deals extensively about this topic. Okay, very extensively it deals about this topic. But right now, what you have to understand is when the interest rate is going up, bond price comes down. It has inverse relationship with interest rates. And when the interest rate comes down, bond price goes up. Okay, so basically what it is trying to tell you is in different scenarios, our profit and loss, can change. Like scenario is same over here, like interest rate is going up, but you see Mr. X in the first case is gaining profit. In the second case is getting losses because this bonds price will come down when the interest is going up. So let's say it has come down to 950, but he has to pay how much? 100,000 to buy this bond.
Okay, so
Yeah. What is the other doubt?
the, that's all I have from my side.
Okay. Subhajit, what are your
Uh,
doubts?
so, like, first, let's do FCFE. We are left with it.
FCFE. Okay.
Yeah.
Okay, fine. So in equity, Okay, so by mistake, actually I left. There is one small concept in equity that I left by mistake. So Subhajit uh, informed me this today. So I'll just cover that quickly. See, we
We
did,
were done with FCFF, only the African.
but I'll just shortly I'll tell you. We did FCFF because then only it will be easy for me to continue. So we did like this: net income plus depreciation plus interest into 1 minus tax minus working capital investments minus fixed capital investments. Okay, and like this only we also did EBIT into 1 minus tax, then plus depreciation minus working capital investments minus fixed capital investments. The next one is EBITDA into 1 minus tax, uh, then plus depreciation into tax minus working capital investments minus fixed capital investments, and then CFO, CFO plus interest into 1 minus tax minus fixed capital investments, free cash flow to the firm. Now, once I get free cash flow to the firm, how can I calculate? Uh, how can I calculate FCFE? Because free cash flow to the firm means both bondholder and equity holders. Now, free cash flow to equity. Free cash flow to equity will have free cash flow to equity will have uh, free cash flow to equity will be, so first free cash flow to the firm. Free cash flow to the firm. So free cash flow to the firm, how can we find out free cash flow to equity? Now, because this is firm, let me remove the bond person. Interest into 1 minus tax. And then plus or minus net borrowing. Plus net borrowing means if they are borrowing more, then add up because more cash is coming in to the equity holder's hand. If they are repaying the borrowing, then it will be minus. Okay, net net. This is free cash flow to equity. Okay, you understood what I have done here. Free cash flow to the firm. From the firm minus, you remove interest guy. Then plus if they have borrowed more, net plus net borrowing. Or if they have repaid the borrowing minus net borrowing. This way we will get free cash flow to the firm, free cash flow to equity. Another way is CFO. That means this method. Okay. So from CFO, if I have to do, then CFO. Acha, I told that this CFO you don't have to worry now because this one I didn't explain this to you, right? Because this CFO you will learn in FSA. Okay, the CFO you will learn in FSA. Okay. Uh, so right now I'm just telling you directly. So because without understanding CFO, you will not understand this. But in FSA, we will be repeating all this once again. So I'm just telling you directly the formula. Um, plus, uh, not plus, minus fixed capital investments, and then fixed capital investments, and then uh, plus or minus net borrowing. Okay, this is the formula. Also, in fact, Shortly, if I tell you this, this and this together constitutes CFO. Okay, but let's not discuss all this now. CFO, you just see whether you are okay with this part. Okay, this is just you blindly take it now. When we do FSA, you will understand. This is okay now.
And we are from FCF, if we are deducting interest and adding net borrowings.
Yeah. If we are borrowing more, if we are repaying more debt, we will
Okay.
we will minus it because cash outflow will happen. No?
It's plus and minus, right?
Yeah,
Net
yeah,
borrowing.
yeah. Plus or minus.
I'll copy it. So just
Yeah. Has it done?
yes, sir.
Okay. Okay. What is the doubt now?
Yes, sir. Just a minute.
Hmm.
So in the first chapter, the 16th one.
Equities,
Yeah, yes. Good. Curriculum.
curriculum.
Yes, sir.
Okay. Okay. Wait. Okay. Are you using 2024 curriculum or 2025? Let
No,
me
sir.
see.
It's 2025.
Let me see if I have 2025 curriculum. Equity. Yeah, yeah, I have. Yeah. Ah, which one you said?
16th one. Like, I think it's related to derivatives.
So if it is related to derivatives, don't do it now. Have we done that one or not? We have done that one. Forward futures related.
No, we just started with it yesterday. It's a sum, sir. It's a sum.
Uh, okay, what is that page number?
It's page number 71.
This one. Which question?
16th one. The standard S&P one.
Okay, Standard and Poor Depository Receipts is an exchange traded fund in the US that is designed to track S&P 500 stock market index. Okay, the latest price of the Spider is 290. Trader has just bought call options. Okay, so we can do it is call options only. The latest price of Spider is 290. Trader has just bought call options on shares of Spider for a premium of 3. So there is holder, there is writer, 3 premium. Okay, and right now the price is 290. Okay, what is the strike price? The call option expires in 6 months and has an exercise price of 305. 305 strike price or exercise price. Okay, both are same, 305. And spot price is 290, so I'll write below this 290. On the expiration date, the trader will exercise the call option. On the expiration date, the trader will exercise the call options on the expiration date. The trader will exercise the call options if and only if the shares of Spider are trading more than 305, then only we will exercise, right? So above 305.
It's B.
Above 305. Right. This is what we did last time. That if it is more than 305, then only the holder will exercise. Okay. If it is below 305, it doesn't make any sense. If it is above 308 also, no. Okay, why? Because even if it reaches to 306, I will gain 1 rupee profit and I have paid 3. So my net loss will be -2. But that is better than taking loss of 3. Is it okay?
Yes, sir.
Okay. Shravan, you understood this question?
Yes, sir.
Ha. Okay, what is the next question? Next doubt.
The 17th one.
Okay. Jason Schmid works for a hedge fund and he specializes in finding profit opportunities that are the result of inefficiency in the market for convertible bonds. Bonds that can be converted into a predetermined amount of your company's common stock. Okay, Schmitz tried to find convertibles that are priced inefficient, converted into predetermined. Okay, tries to find convertibles that are priced inefficiently relative to the underlying stock. Okay, the trading strategy involves the simultaneous purchase of the convertible bonds and the short sale of the underlying stock. The above process could best be described as arbitrage, hedging, and securitization.
Like, is it hedging?
One second. The stating predetermined amount of a company's
It's like
the
because
trading strategy involves simultaneous purchase of the convertible one and short sale of the common stock. Simultaneous purchase of the convertible bond. Okay, and short sale of the common stock. So you short sell, you have to uh, yeah, that is hedging. 1 minute, let me still confirm. Wait. Works for a hedge fund and he specializes in finding profit opportunities that are the results of inefficiency in the market for convertible bonds. Bonds that can be converted into a predetermined amount of your company's common stock. Converted into a predetermined amount of your company's common stock. Schmidt tries to find convertibles that are priced inefficiently relative to the underlying stock. Schmidt tries to find convertibles that are priced inefficiently relating to the underlying stock. Okay, bonds are inefficiently priced. The trading strategy involves the simultaneous purchase of the underlying bond and the short sale of uh, common stock. Hmm. It is arbitrage, no? Because between arbitrage and hedging. So uh, you have to you are short selling. When you short sell, when you short sell, let's say 100 rupees, you are short selling. That means stock you believe is overpriced. So it will come down and you have to again buy. And on the other side, purchasing of convertible. So if you are purchasing convertible, so you expect the price to go up. So when it goes up, so let's say from 80 it is going up to 90. Okay, then I have to uh, yeah, it is hedging. Just check. Not 100% sure though, but hedging I think. Just check. Aja, I'll check here. 17th, na?
no, it's B. It's
Arbitrage, they said.
arbitrage.
Okay.
So is it like they're first buying the convertible bonds and then once it is converted into shares, then they're short selling it, or are they doing it simultaneously?
The keyword, see, for arbitrage, it is always simultaneous.
Okay.
But my confusion was Convertible means we have to assume then it can be easily converted, and quickly I will be able to pay off for this stock. Then that is the assumptions which I did not assume. That was my doubt, because
So,
when
sir,
you are
like
talking, you have to
usually, if
buy as well, na stock.
yeah.
Huh. So here
So
they are
when
saying you will buy here
hmm,
and you will convert it here and then you will give it here.
okay,
Okay. Huh.
but like even like if you buy those bonds at a higher price, and then why would you want to sell it? Like
These
buy this stock.
prices are closely related at different price in different markets. Yeah. Huh. What did you say?
Like if I buy a security as in a bond at a higher price, why would I convert it into securities if the securities are, let's say undervalued right now?
See, how it is working here is I'm buying a convertible which is priced very low.
Okay,
Acha, this is how I'm buying a convertible which is priced very low, and immediately I will convert.
okay,
So I'm buying it. See, I'm buying it and I converted into a stock for 80.
right.
Okay, but I have sold this for
Yeah,
100.
are you writing something?
Yeah, you are. Acha, I'm not sharing.
You have not shared the screen.
Okay, so far I was. You were not seeing my screen, is
No,
it?
I was like I was seeing the question.
See, it is working like this. Yeah, yeah, it is clear now. See, 100 rupees stock you have sold, you have short sold. That means you have to buy at the lower price. That is your intention, correct?
Yes.
Now this was overpriced, so you have shorted. Now instead of buying directly in the market, what you have bought is you have bought convertible
Yeah, so
at
I
80,
got it at a cheaper price.
at 80. So and
Okay,
then immediately you will convert it. So
right,
now it has come over here at 80
right.
and then give it to this guy. So that is arbitrage then. Arbitrage means simultaneously buying and selling without even involving your money. So what we have done here, we got money from this shorting,
So
and
you
that money will be
sold it for
invested here.
80.
Yeah, for
Okay.
sold it for 100, we got 100. We invested 80 here.
Yeah,
We got equity.
80. Yeah.
Then that's it. In between 20 is the profit. So without involving our money, and simultaneously we are buying and selling. We are buying from the market where it is priced lower, and we are selling in the market where it is priced higher. So that is arbitrage.
Okay. But they've said they're short selling, right? Then he
Yeah.
would have to wait for the prices to go down of the equity.
Huh.
Like you said that he's buying the bond at 80 and selling the shares at 100, but then he has to wait for it to go down more, right? Then only he'll make profit out of it.
Uh, Now this convertible is already trading at 80.
Okay.
Okay.
Yeah. Yeah.
So when it
So
is converted into equity,
yeah.
assuming at the same price,
So he
then it
got
will come
profit of 20 rupees, like he earned
20.
it.
Yeah, yeah.
But then in short sell, what we do is we wait for the prices to go down, right? And here we are not doing it. That's what I'm asking.
Acha, acha, acha.
Yeah.
Uh, Ideally, when it is converted, uh, now not necessary that it is exactly getting converted at 80, right?
Yeah.
Even if it is 90, basically it is undervalued. So what your prediction is, it will come down in the market.
Yeah.
Okay, because it is overvalued. Now equity is
Overall.
overvalued. So it will come down in the market. So if it is not 80, at least at 85 or 90,
Hmm.
because you have the right to convert it. So
Yes.
normally what should happen is, when you are converting, when many people are converting like this, automatically there will be more, selling of equities. How? Because more people are bringing equity supply is going up now in the market. So that's why the price will come down then. And also, when you know that this is overvalued, so it is supposed to come down.
Right.
Hmm. Is it okay?
Yes. And then,
Okay, what is the next doubt?
18th one.
Okay, just 1 minute. Hold on. Okay.
Yes.
Hello.
Yes. Sir.
Ah. Robert just purchased a call option on shares of Michelin Group. Call option. Okay. A few days ago, he wrote a put option on Michelin shares. The call and put option have the same exercise price, expiration date, and the number of shares underlying. Considering both positions, Robert's exposure to the risk of the stock. Uh, okay, this you will understand only when I will explain put options also. No?
Okay.
Okay. So let me explain then here, or I'll explain put options. Uh, no, I'll have to properly explain then. So you ask this question later once I finish put options.
Okay. Sure. Yeah.
So it is a good question. So you just keep this aside. Once we do put options, we should handle this question. Okay.
Yeah. Yes. And then 20th one. So what I'm getting is key, I think. Then.
A trader has purchased 200 shares of a non-dividend paying firm on margin at a price of $50 per share. The leverage ratio is 2.5. 6 months later, the trader sells these shares for 60 per share. Ignoring the interest paid on the borrowed amount and the transaction cost, what was the return to the trader during the 6 months period? Okay. A trader has purchased 200 shares of a non-dividend paying firm on margin at a price of 50. The leverage is 2.5. So leverage ratio is equal to 1 by initial margin.
Yeah.
So
So
leverage
2.5
is,
is equals to 1 by initial margin. Yeah.
so initial margin is equal to 1 by 2.5. What is that equal to?
Oh, okay. Just 1. I think it's 40. Yeah. 0.4. So 40%.
So initial margin is 40 percentage. Okay. On margin at a price of 50 per share. 6 months later, the trader sells these shares for 60. Okay. So 40 percentage, right? So the price is 50 So what is 40 percentage of 50?
I think 20. Yeah.
So 20 rupees he invested, 30 rupees he borrowed. Okay. And there is no other transaction cost, no? Nothing.
No.
No. So he invested 20. This is cash outflow. Now, what is a cash inflow? Cash inflow is uh, no 20 he invested on one share into 200 shares.
So he borrowed. No, he paid 20 and borrowed 30. Right?
He uh,
Yeah, he borrowed 30 rupees.
acha, total amount will be 50 into
Two 200.
200 shares. No?
Yeah.
So 10,000 rupees is the one. 4,000 he invested, 6,000 borrowed. Is it okay?
Yes, sir.
6,000 borrowed. Then what happened? Then he sold it for 60. So that means 60 into 200. So 12,000 he received. Out of that, he must have paid back the borrowed amount 6,000. Repay borrowed amount 6,000.
6,000. Yeah.
Okay. 6,000 repaid. Now there is no interest and all to be paid here. They
No.
said ignore. So net he would have got 2,000 6,000 in his hand.
Yeah.
So he invested 4,000 and he has 6,000 in his hand.
Yeah.
So now the question is, uh,
So it's
what
yeah,
was the
50%. Is
yeah
it C? I'll
it
check.
is yeah. Yeah.
Yeah, it's C.
Mm,
Just a minute, sir, I write it down quickly.
mm.
Done, sir.
Mm. Okay, what is the next one?
Yeah, 21st one.
Mm. Jason Williams purchased 500 shares of your company at 32 per share. The stock was bought on 75% margin. That means initial margin is 75. Okay, 75 percentage margin. 1 month later, William had to pay interest on the amount borrowed at a rate of 2 percentage per month. At that time, Williams received a dividend of 0.5 per share. Immediately after that, he sold the shares at 28 per share. He paid commission of 10 rupees, $10 on the purchase and $10 on the sale of the stock. What was the rate of return on his investment for the 1 month time period? Okay, so initially 500 shares at 32. How much it comes to?
16,000.
16,000. Okay, and was bought on 75 percentage margin.
margin.
So 75 percentage is our money into
Yeah,
75.
25 is borrowed.
Yeah. What is that 75 percentage?
70, just 70, 32. It's 24 rupees. So 24 into 500. Right? So it's 12,000.
75 percentage is 12,000, right?
Yeah.
Okay. So 12,000. Okay. So this is the amount that we have paid. Plus, what did we pay commissions? We paid commission of 10 on the purchase. So this is our total paid amount. Is this okay? What we have paid.
Yes.
Now, what will we get? What we are getting is we sold it, we received dividend, and also we sold it for 28. So 500 shares into 28 is how much?
500.
Hmm.
It's 14,000. One four.
So now 14,000. Now when we have sold it, plus we also got dividends. So
Yeah.
plus dividend. Dividend is zero point 0.5 per share. So 0.50 into 500 shares. How much? 250.
0.5 into 500. Yeah, 250.
So we have received this much money. Out of that, what did we do? First of all, we have to
4,000.
repay borrowed amount.
14 to 50 minus 4,000. So that will be 10 to 50.
So 4,000 we have borrowed here.
Yeah.
So borrowed 4,000 you pay. Then we have to pay interest also. 2 percentage per month.
Okay.
So how many months? 1 month. So 2
1 month. So
percentage.
2% of 4 is
2 percentage of 4,000 is calculate.
80, right? 80.
Huh?
80. I can say. Yeah, 80. Is
80. This is the interest. Then commission. Commission
commission
is 10.
from the fees.
That's it, right? Commission paid on sale 28.52 percentage. That's it. So calculate how much
So
on
10,160. Yeah.
coming to 10,169,
Yeah.
is it? Or 160?
10,160. Yeah.
Now closing value 10,160 divided by
Yeah.
opening value
12,000, right?
minus
12.
1. Ah,
So it's 84.66%.
no, no, no. That means no, no, no.
Okay,
Uh,
sorry. 84.6% is the remaining
remaining,
amount. Yeah.
yeah. Okay.
So
So remaining is the
it's
loss. So here you take the difference otherwise divided by 12,010. Take the difference.
it is 10,160 divided by 12,000 minus 1. Yes, it's 15.33. So it will be B.
Hmm.
B.
Okay, check.
Yeah. Yeah, it's B.
Mhm. Yeah, yeah.
So they've done it in some different way. I don't know. They're getting different amount. Like they've said 1850 per net gain or loss. Okay, so it's a total of all those charges, right?
Hmm, hmm. How have they done?
No.
12,010. Okay. 18. Acha, it is
Yeah,
not
they
80.
said they've paid commission of total $20. So both time they're paying commission. Is
Yeah, even here we have paid now
okay. Both the time.
both the time.
And then, okay. So 1850 is all the charges they've added up. Okay,
Net, acha, just calculate the difference between these two.
okay, 12,000 minus 10, 160.
Ha.
Okay, okay. So that 12,000. Yeah, it's 12,000. Yeah, it's yeah, correct. Yes, sir.
Matching?
Yeah,
Okay. Okay, shall we stop now here? Because
yes, sir.
you people might want to sleep now. So we'll see tomorrow 9 o'clock. We'll connect and continue these doubts. Okay.
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 Okay, sir.
Yeah.
Bye, sir. Thank you, sir.
Thank you, sir.